Thank you for joining us at XM.com. You're watching today's Daily Market Comment by Mario Sajikyriakos. I'm Christina Marukos. All eyes will be on the FOMC rate decision today. Investors expect the Fed to wind down the pace of rate increases by rolling out a 25 basis points hike, but the market reaction will depend mostly on Chairman Powell's economic commentary. It will be a tough balancing act for the Fed chief. Inflationary pressures are finally moderating and leading indicators point to an economic slowdown ahead, but the labor market is still exceptionally tight. Powell could stress how strong the labor market is and that inflation remains uncomfortably high, pushing back against market pricing for rate cuts later this year. Investors are not positioned for such a resolute message, judging by the latest moves. Stock markets are partying, the dollar is soft, and implied volatility is extremely low, so there's no real concern that Powell will beat the hawkish drums once again, but that could be a mistake. A sense of euphoria has engulfed financial markets this year. The classic narrative is that global economic fortunes have brightened. The Fed is near the end of its tightening cycle. Europe might dodge an energy-driven recession after all, and China's economic reopening will help lubricate demand. In reality, this excitement likely reflects a massive liquidity dump, which has countered the impact of the Fed's balance sheet reduction process. Even though the Fed continues to drain liquidity out of the system through quantitative tightening, this effect has been more than offset by reductions in the reverse repo facility and the Treasury depleting its cash balance lately. Net liquidity was added back into the U.S. financial system this year, explaining the sensational advances in stocks and the dollar's inability to sustain a rally. The proof is in the pudding. The best performing shares this year are unprofitable, low quality, and heavily shorted companies that got smoked last year. These are assets that live and die off liquidity flows, similar to other recent star performers such as altcoins. When liquidity is abundant, there's a tendency for stocks to disregard bad news and for the dollar to be fragile, but this is likely a temporary phenomenon. It could reverse once a debt ceiling deal is reached in Congress and the Treasury begins to rebuild its cash balance, which elevates the importance of today's meeting between President Biden and Republican House Speaker McCarthy on the subject. From a risk-reward perspective, it's tough to be optimistic on equities when the S&P 500 is trading at 18 times forward earnings in a macro environment where corporate profit growth is rolling over. Thank you for watching today's Daily Market Comment here at XM.com.